Whirlpool. Holy cow, when you look at Whirlpool is a disaster. So Whirlpool is down 13%, is already down 15% heading into the quarter for the year. Remember, we're at all-time highs here. When I look at this company, how much is down and getting crushed where expectations were so low, I want to look through the quarter, and at first glance, if you don't know Whirlpool, you're like, tariffs, that's why. This is finally impacting a certain amount of companies, and Whirlpool, wrong, absolutely wrong. In fact, Whirlpool is supposed to be one of the biggest beneficiaries of tariffs, since most of the manufacturing is in the US, which should be increased demand. Why is demand not increasing? Because the housing market is absolutely horrible. Nobody could buy houses right now. Very few. You're seeing high-end houses. You're seeing strong over $800,000. $1 million houses are getting sold. That's fine. People get more rich, the markets and stuff like that, and they're paying cash. Outside of that, when you have trouble, say you have a $500,000 house in New York or California, and you want to move to Florida, and you're saying, okay, I'm going to buy this house for $500,000, and you have a mortgage on it, your payments are going to increase dramatically because interest rates are high. So you can't move sideways for the same amount. And you're not going to go from a $500,000 house to a $300,000 house, right? People just don't do that, especially if they have the money. They just don't want to pay a much higher mortgage simply because of an interest rate. So everyone's waiting for rates to come down. I think the Fed is going to lower rates. I think Powell will lower rates at least twice by the end of this year. Maybe we see 3 rate cuts by the time his job is gone. But when I look at Whirlpool, holy cow. I mean, this is an example of how terrible the housing market is. And there's lots of companies tied to this trend that I think are going to see the results. Whirlpool has been kind of crappy for a while, but especially past couple of quarters, you're going to see this filter down to a lot of these companies. It's just, the home builders are good. They have their own loans. They have their own concessions. They're able to make deals and stuff like that, that they manage these positions, that they're smart through these periods. But man, when you have something that's like their appliances and everything's going to be bought based on, home ownership, and you don't see a lot of people buying new homes, it's going to crush you. To be fair, this is a great managed company. And the management team here, this isn't a company losing money. This isn't a company going out of business. They're generating $400 million in free cash flow this year. They had to cut their dividend. They're cutting their dividend. It was over 7%. Makes sense. I love when companies do this. Their stock's getting nailed on it, but it's smart. I mean, the amount of money you're going to save and putting into buybacks would be so much better than paying this dividend. And there's proof to that. I've done studies on this. I've seen studies on this. Buybacks outperform. If you bought companies that bought back the most stock in the past 20 years, you would have outperformed the S&P 500 pretty much by 3-4 percentage points. Now, compound that shit over that period, and everyone's like, you should own S&P 500. Maybe not. Maybe you should own the best companies S&P 500 that are buying back their stock. Because if they're buying back stock, what does that mean? It means they generate a shitload of free cash flow. It means that they're doing great, they're growing, they're killing it, right? Those are the companies. And those are usually the best companies that you're also going to see momentum out of. It makes sense why they're outperforming the S&P 500, where you have companies like, Exxon's doing a little bit better now, but the Exxons, the Procter & Gamble's, that they're like, well, we're a dividend aristocrat for 25 years. We have to raise our dividend no matter what. J&J, 10 straight years of shit. We got to raise our dividend. It doesn't matter. We got to stay on that list. I like this decision. Does it suck for investors in the short term? Yeah, but it's a really good decision if you want to hold the stock the next 3 years, because I'm going to tell you something about Whirlpool. As shitty as it is right now, they're expected to earn $7 a share, which is a lot lower. That's a major cut, and that's being conservative. On that basis, that stock's trading at just 11 times forward earnings. If you were a believer, you could believe me, you could agree with me, you could not. Again, it's my opinion that rates are going to be a lot lower. And people say, well, they could lower rates and long-term rates could still be higher, which the mortgage rates are based on. Whatever you believe. If you really believe interest rates are going to go low, even a percentage lower, and you're going to see that stay there for, say, a couple of years, Whirlpool's an easy double from here. It's an easy double from here on this pullback. You're going to buy it. You're going to see some pain. It's not exciting. I know you want to buy a freaking crypto company that just is taking off, that these freaking Bitmine immersion companies and whatever are going up, 1,000% in like a week and shit. I get it. I get that's what you want. Everybody wants that, right? I mean, it's crazy, but that's what you want. It's a flavor of the week. You want to make money right away. This is a company, put in your portfolio, forget about it. In 36 months, it's going to double. And those are great returns for the next 3 years. If you're going to average those returns over the next 3 years, that's really good. And I'm telling you, if you think interest rates are coming down, this company's going to benefit tremendously as it frees up the housing market. Because right now, man, that housing market, I'm surprised that the markets are where they are without contributing from housing and without really contributing to manufacturing, which now we're seeing, right? So we saw manufacturing. It's why oil, if you look at oil, look at global manufacturing, has been down tremendously. Now that we're signing deals, you haven't really seen the effect of oil going higher because of that, the expectations, but look at infrastructure, the best performing sector in the whole freaking market. Because of all the expectations of all the manufacturing, all these deals are being signed, all of them. I mean, even Mike Wilson from Morgan Stanley is bullish, citing how much massive amount of loans within infrastructure are being taken out for future growth, which is great. It'd be even better if it was at lower interest rates. We'll see where that goes.